Hey everybody, how you doing? This is Eric Worrell here with rentprep.com, and I'm really excited today. Some of you probably already recognize our guest here, Mark J. Kohler. How you doing, Mark?
I'm rocking, man. Thanks for having me.
Mark,
I,
thanks so much for being here. I mean, I'm really excited about this. We got a lot of questions that are based on taxes, right? We got this new tax bill that's come in. We got all these landlords that have questions. I mean, everybody's got questions, right?
yeah. Why don't we just ruin everybody's lunch hour? Good idea.
So before we jump into that, Mark, why don't you just tell us a little bit about what you do? Because I mean, you're all over the place. I mean, you got books, you're like a national speaker, you're a CPA, an attorney, and I feel like I wouldn't do it justice.
Oh, you're so kind. Thank you. And I do, all joking aside, too, I want to thank everybody that's watching this. If don't scroll through this, pay attention for the least first 15 minutes, and then you can decide if you want to listen further. But don't just disregard it because it is about taxes. This will affect all of you, especially if you're a real estate investor of any sort or fashion. And I want to give you some clear-cut direction. There's no boot camp in Vegas next week to get the real answers. It's all right here. We'll do the best we can. What do we have, Eric? 20 minutes, 30? What are we doing? 40?
Hey, yeah, 30 minutes, as much as you can give us. We appreciate every minute.
All right, we'll do all we can. And then I'll give you folks some resources, some maybe even a free ebook or some place to get more information with my weekly newsletter. So there's no sales pitch here. This is just content. I love Rent Prep. I love what Eric's doing and his partners over there. So hopefully I can provide some good insight. So don't go anywhere. Taxes can be fun and interesting. I'm going to try to keep it real.
All right.
So anyway, I'm a CPA, an attorney, best-selling author. I got a new book again out this last year, The Business Owner's Guide to Financial Freedom, and what Wall Street isn't telling you. And there's a lot of good real estate golden nuggets in that. So if any of you have wealth, you're a business owner, and you're thinking, where do I deploy? What do I do? That's my new book. You can check me out on Amazon. Just Google Mark Kohler, and you'll see my info out there. I've got a weekly podcast on iTunes that is one of the top 10 in small business.
Yeah,
and it's
excellent.
Thank you. And it's on tax and legal. So we're not talking sports or, marriage therapy. It's all about tax and legal strategies. You're building wealth. It's a great podcast. And then our weekly newsletter. I speak here and there. I've been on some great news shows recently on MSNBC and Fox. So that's me. So I'm grateful to be here. And I love real estate. I'm a real estate investor myself. I'm even working on a flip right now, where I should be tomorrow or this weekend, but I'm not going to. I'm going to be in the office. But anyway, so that's me.
All right, perfect. So what do you want to start with here? Do you want to start with just kind of talking about the tax bill and maybe just a little bit of background? I know you've got a lot longer content on this, but I mean, what do you want to start with, that or the Q&A?
Yeah, let's do this. So everybody knows we've already got a list of about 10 to 15 questions. But before I jump into those, let me give a broad overview. I've got a little post-it here of like 3-4 points I want to make. And this is going to be really helpful and give you guys some context for today's conversation. Now, believe it or not, there's really 3 categories of real estate professionals. I'll use that word. There are you passive investors in rental property. That's one category. There's my realtors and brokers. That's a category. And then there's the fixers and flippers. Okay. Now, you might be all 3. I get that, people. You might be doing all 3. I've got rentals, I'm a realtor, and I've got a flip going on. That's cool. But the rules of the new tax legislation kind of put you in boxes, and I want to give you some feedback that might be helpful. So let's grab the low-hanging fruit first. All of you that own rental properties, no changes. There's nothing to really worry about when it comes to, and I'm going to get a couple other tax strategies
to
go with this, but generally, as a real estate investor, your depreciation models are the same. The years didn't change. You're still real estate professional, active, passive, classifications, carry forwards, carries back, all that's the same. So if you own rental property, business as usual, no change. Okay. Now, next, should I go good news or bad news first, Eric?
You know what? I like to go bad news. I like to start or finish on a good note.
Okay. So realtors and brokers, you got the shaft. Now, let me tell you how and why. This 20% pass-through, okay, the 20% deduction on pass-through income. So let's say you bring in 150 grand, you got 50 grand in write-offs, and you net 100. You get a $20,000 deduction off the bottom line. So you're only going to pay taxes on $80,000. kind of a big deal.
Mm-hmm.
So that's a really good thing, but it does not apply to passive income. So none of you any of you out there buying real estate as rental property, you don't get that 20% pass through. It's only for my fixers and flippers, rehabbers, property managers, and realtors and brokers getting commissions. So that you get that 20% pass through deduction off the bottom line. Now, first point is, before we get in a little further, is do not think that going to an LLC or a sole proprietorship is going to save you. It will cost you more. The S corporation is still your entity of choice. You want to do your salary dividend split. You want to take that 20% pass-through deduction on the K1 or dividend, for lack of a better word. Any accountants out there freak out when I say S corp and dividend, but it makes sense to people. But that pass-through income from your S corp and a salary in an S corp with this new GOP legislation is like magic. So if some of you are like, well, my accountant doesn't say that, or you've never heard of this, I'll give you my contact information at the end of this webinar. You've got to get some support and help there. We can do it really affordable. We got 5 tax attorneys in my office here that can hook you up. So keep that in mind as we talk about this. Now, realtors, here's why you get screwed. This 20% pass-through phases out because they don't think you're going to go out and hire a bunch of new employees and invest in infrastructure. Mm-hmm. You're not going to get this 20% pass-through forever. You phase out. Now, if you're single, it starts to phase out at 157 grand. If you're married, it starts to phase out at 315 grand. Now, not every one of my realtors is making 300 grand a year married or 150 grand single. I get it. But for any of you realtors that are kicking butt and doing fix and flips on top of it, you're going to have some problems because it's based on your AGI. And you say, well, Mark, I only made 50 grand as a realtor, but fix and flipping, I made 200 grand. Doesn't matter. If your AGI hits these limits, you don't get the 20% anymore because of this realtor classification. Now, we're hoping for some regs on this later this summer that can maybe divide your income into 2 types, but we haven't seen that yet. So for right now, realtors and brokers, if your AGI is over 157 single or 315 married, you're going to have issues. Now, the good news, if you are strictly a rehabber, developer, property manager, well, then you're a realtor again. So forget that. But if you're a rehabber or fixer flipper, there's no limit on the 20%. You're going to continue to take that at any income level. You could make $1 million and get a $200,000 write-off. Now, it is limited to 50% of your wages, but you're going to have wages because you're a flipper and rehabber. That's why Congress gave this to you. They want you to take that extra money and go hire more people and build the economy. So in summary, same rules for real estate investors with rentals. If you're a realtor, remember, if you make too much, this 20% pass-through is going to go bye-bye. And if you're a fixer and flipper, enjoy the ride. For the next 7 years until 2025, you've got this wonderful strategy. So that's the general rule, and I've just got one other point. So, Eric, what do you think? Any follow-up on that with me or anything?
No. You're the expert here. I actually was telling people in our newsletter when I sent it out, like I don't know what I'm talking about. That's why Mark's here. So you're running the show here, Mark.
Okay, you're just eye candy. You don't want to look at Eric.
I'll take it. Thank you.
Okay, all right. No, here's a rule that affects everybody. Now, this is important, everybody. Then we're going straight to your Q&A, and I'm all yours the rest of the time. Last point. When you buy rentals, you're a business owner. When you're a realtor, you're a business owner. When you're a flipper, you're a business owner. Remember that, folks. At the end of the day, you're still an entrepreneur. So I want to maximize all your write-offs. Mileage, auto, travel, dining, home office, cell phones, internet, computers, Apple Watches, anything. I want to write all that off. So there's been a couple changes. Meals and entertainment got gutted. Those have been favorites of mine in the past. So, and I've got a table. It's going to be going out in my newsletter on Tuesday. So if any of you want to sign up for my newsletter, I'll tell you now, markjkohler.com. That's probably the easiest. I was going to give you my email, mark@markjkohler, but just go to www.markjkohler, Kohler, Kohler.com, and you can sign up for this newsletter. And I'll give you some more contact information at the end. But if you get over to my newsletter and you sign up, it is free. There'll be a table on Monday that'll give you, or Tuesday, that'll give you more clarity just in a few days. But let me just give you some examples. First of all, entertainment is gone. Bye-bye. No more entertainment events. So that's going out to the theater, going to a baseball game, a football game, going to the spa, going golfing. No longer can you take your best prospect, your best customer, your business partner, your employee, and go out and entertain and talk business. No more write-off. Ugh, right? Where the government give you something good, they take away something bad, you know, and make it bad. So whatever. Meals. Meals have gotten hammered. Let me tell you some examples of what the new rules are. This is from a table you're going to see. Meals in your office. So if you have your staff together, if you buy donuts on Wednesday and bagels on Friday, if you're going to have food in the office, it's now 50%. It used to be 100% write-off. You're still able to take 100% for a year-end party with the employees and their spouses. A certain type of employee recreational get-together. So it's not entertainment, it's for your employees. That's going to be 100%.
Is that limited? Is that like one time a year?
No, you can have monthly employee gatherings and things like that, and trainings and togetherness. You could write off 100% of your meals for a general public marketing experience. So let's say you're going to have a workshop and provide some food. Realtors, if you're doing an open house on a Saturday or Sunday and you're buying food for the open house, when finger food on a platter when people walk in, 100% write-off. That's okay. But if you take one of your prospects out to lunch, this is where it gets ugly. Under the new tax code, arguably, it's zero. No more meals taking someone out. Now, we're expecting IRS regs this summer that's going to clarify meals that are isolated to a meal in business and meals that are tied to entertainment. Those are probably going to still be zero. But everybody, if you still go out and buy food with an employee, a contact, or a customer, write it down, keep it in your records, keep it in a separate column, because there's still some questions there. We don't know what the IRS regs are going to come out on that. We hope it's going to be a write-off, but it could be zero. So 50% with client meals is on the chopping block. So you want to be careful of that. Year-end parties and food for customers, zero. Unless it's a presentation, there's not going to be a write-off for food, just throwing a party for your customers. That's entertainment. See, food, think about it this way, and this is my last point. The IRS considers eating as entertainment, not as I need to feed you. And so that's why it got gutted in a lot of ways. So anyway, okay, folks, so those are some, so be careful of meals. Entertainment's gone. That's across the board, no matter what type of professional you are. And hopefully that gives you a little summary. Now, there's a lot more to the tax code, changes on individual returns and all sorts of other things. I've got an hour presentation. I've got videos on my site. Check it out. Eric, there we go. What do you think?
Okay. I'm getting a little bit of feedback when I talk. So I'm going to have you run with this, and I'm going to try to pull comments up on screen. I think it's just coming through your speakers. Are you still getting the feedback, Damien? Can you hear me, Mark?
I can hear you.
Okay. Sounds like the feedback just went away, but there was a little bit of feedback. Damien had mentioned that I was getting feedback, but it sounds good now, actually. So
maybe if, while I'm talking, you mute, and that might help too. Maybe it's coming back through your
speaker. And it looks like I should be able to pull the comments up. So when you're reading somebody's question here, Mark, just give me their first and last name, and I'll try to see if I can find their comment and put it up on screen.
Okay, I'm going to start from the top of what you sent me before. So it's going to start with Monaco Fabric, and then go to Reed and Leslie and Chip. So if you get that timeline, we'll go from Monaco to Reed to Leslie, and we'll just blaze through it. Okay, everybody, I'm all yours. I'm going to run through these questions, and then we'll see how it goes. Monaco says, my accountant mentioned that if my son lives in one of my duplexes, it might not be considered as a rental. I would like to know what your opinion is on this matter. Monaco, I love it when you own rentals and your kids live in it. I have no problem with that. That should be a rental property. But here's the catch. you've got to recognize rental income. You can't just say, oh, my kid lives there, and take depreciation and write-offs and not claim rent. If your kid's a renter, you got to treat them like a renter. That means you have to claim some rental income, and it has to be fair market value. Now, you may say, well, I'm not going to have my son pay me rent. Well, claim it as a gift, like you're gifting your son rent. So you claim the income, even if he didn't actually give you physical dollars, as if you gifted him rent. I hope that makes sense. So here's the summary. Folks, I love you to own rentals. I don't care if you're family. Even I have clients that will buy a house from their mom or dad that continue to live in it. And if you want to depreciate it and treat it as a rental, that's cool, but you got to claim rental income. So Monaco, I'm fine with it. In a duplex, single family home, whatever, family can be there, but you got to claim rent. Reed Baker, he says, if I rented my property for 30 years and then decided to make it my primary residence for the last 2 years prior to selling it, how does that change the tax rules upon its sale? Oh, Reed, this is interesting because this is recorded. The IRS may be surveilling, right? Okay, Reed, here's the technical rule, then I'll give you the practical rule. The technical rule is when you go to sell your primary residence, which used to be a rental, when you go to sell it, you've got to recapture depreciation. You got to own up, be honest, and on your tax return, you're going to reclaim that depreciation. And you can also, arguably, the rule is you're supposed to bifurcate the gain you had while you had it as a residence and the gain you experienced while a rental. So you got to kind of look at your gain, and you're supposed to bifurcate it and put it all in your tax return. Now, if you're honest, law-abiding citizen and you do your tax return, you're always supposed to be honest. You would report it this way. And plus, you know, Reed, this is big. When you get to the pearly gates and Peter's welcoming you in, you want to be honest and say, hey, I'm good, you know. Anyway, but here's the practical issue. It's very easy to hide in your return. You're going to sell your primary residence and all of a sudden, poof, it's gone. And so some people abuse this. If you get audited, the IRS will be ticked and you'll pay some penalties and interest. But it's on you to report the portion of gain while it was a rental, and then the portion of gain while it was your primary you can exclude. The IRS just 5 years ago, Eric, was interesting. You could convert it to a personal residence, sell it, and nothing. But the IRS cleaned it up and said, no. You got to look at the whole entire holding period, claim this part as income, this part is excluded. Anyway. Okay, Leslie says, I have 3 rental properties and have not gotten an LLC as of yet. Leslie, you're killing me. But would like to know what the tax benefits would be if I need becoming an LLC. Leslie and everybody listening, you're going to love this. LLCs do not save taxes. Should we make everybody repeat this? LLCs do not save taxes in any way, shape, or form. Now, for you realtors and fixer flippers, you might have an LLC taxed as an S corp. Well, that means you're an S corp. So don't say you're an LLC. Once you choose to be taxed as an S corp, even though you might have the LLC at the end of your name, you're still an S corp. S corporations save taxes. And that's when you are a fixer and flipper or realtor broker. But if you own rentals, Leslie, the LLC will not save you taxes. But should you still have an LLC? Freak, yes, you need one, because you do not want to be personally liable for the tenants and any contractors or problems or patrons or visitors and all that stuff. Now, I don't know what state you're in, but you can do it very affordably. We have a $400 setup fee that's the same as LegalZoom. Don't think LegalZoom's $100. It's not. When you check all the boxes, it's a lot more than that. We literally have a service that's called fixmylegalzoomentity.com. So if you go out and just click on the web or go to the state and say, I've got articles, I have an LLC, bull crap, good luck in court. I talk about this on my radio show all the time. People, an LLC needs to have guts, it needs to have operating agreements, you need to do minutes, and you need to maintain it just like a corporation. Now, I know some of you are hearing this going, that's not what my accountant said or my lawyer. Well, when you get into problems, you tell them they're liable, not you. Good luck. Now, Mark, I write on, yes, asset protection. Be careful. Eric, go ahead.
Yeah, and your team will help as far as like organizing those minutes and kind of like a yearly thing?
Absolutely. We have a company maintenance program that's $150 a year. It's cheap. It's easy.
Yeah.
So you can go to our website, kkos KKOlawyers.com. That's KKOS as in Sam, lawyers, LAWYERS.com. And we've got a maintenance program. Just click on services, company maintenance. And so, Leslie, $400 for a setup or $800 for a setup, and you get an hour with a real tax attorney tailoring the plan to you. So pony up, do it right. You could put all 3 rentals in one LLC. It'd be a good start. Chip Kogan says, if I'm buying a property to rehab and rent, do I need to keep track of expenses differently before the property is put into service or versus after? Well, Chip, the technical rule is while you're in the process of rehab, you're going to be keeping track of all those expenses that are directly related to the rehab. Those are going to go towards the basis of the rental when you turn it into a rental. So when you buy a property, everybody, to fix and flip, it's just going to go right on your books. You bought it, and you're going to start putting money into it. You're not going to depreciate it because you're going to flip it, right? But if you turn it into a rental, then any improvements you made before you turned it into a rental in that kind of period when you were rehabbing it goes into the basis for depreciation. Now, while Chip is along the way there, he's going to write off his cell phone as an ordinary expense. He's going to write off his home office, his mileage, his pizzas for all of his workers at the location. That is all a write-off immediately. It's only the direct rehab costs that are going to go into the basis when you turn it into a rental. Now, your accountant should know this. They're going to put it together for you, Chip, when you do your books. John Riley, he says, please explain what advantages of being a real estate professional are, as defined by the IRS, has been materially involving in managing our properties. So he says, Mark, there's a typo here or something. He says, I've been materially participating in my management, but what's so cool about being a real estate professional? Oh, if we had the time together. Oh, man. John, I just want to take you out to dinner and just, wine and dine you on this. Guys,
That's not tax deductible though, right?
That's right. It would not be tax.
I'm listening.
Yeah, you're listening. I've written articles in this. I have videos on YouTube on this. I've got longer videos on my tax and legal library video series on my website. John, let me just say in summary, when you or your spouse, this is everybody listening here, when you or your spouse qualify as a real estate professional, and it's a time test, an activity test, and this and that, then you're able to deduct all of your rental depreciation 100% against any other income of you or your spouse. Huge. So when I have clients with a lot of rentals, but they make money in other areas, those losses are oftentimes stuck. They go into a carry forward, which is okay. You'll get to write them off someday. But when you or your spouse qualify as a real estate professional, then all those losses flow through annually as 100% write-off. Me, I'm a tax attorney. I don't qualify. And unless my spouse, Jennifer, meets that criteria, then we carry forward our write-offs. It's just the way it is. John, study up on it. You'll freaking love it. Brian Barnett, how does the new tax law affect landlords? In my case, a single property owned as a sole proprietor. We already talked about that. Nothing changes. Just you're not writing off your entertainment and meals as much as you thought. You're still cool as a sole proprietor landlord. Hope you have an LLC. Get it done, Brian. We'd love to be of help. Eva says, I've just purchased an investment property and will be renting it out. Congratulations, Eva. Are there any tax differences credits when renting by owner, Section 8, or with a realtor company? If I'm making a profit, how much should I set aside for taxes? So Eva throws in 2 or 3 things. Anything else, Eva? Come on, you're getting greedy. Okay, Eva. First, are there any tax difference credits when renting by owner, Section 8, or realtor company? No, it's all the same. You're going to claim your rent. You're going to write off all the expenses, property taxes, HOA fees, mortgage interest, depreciation, mileage, home office, admin, internet, all that same crap. Section 8 doesn't get you anything except maybe more steady rent. If I'm making a profit, how much should I set aside for taxes? Well, even when you're in a rental property situation, a lot of times you're going to have zero taxable income and cash flow. That's the beauty of a rental property. Now, if you own a rental property 100% with no mortgage and you've depreciated the crap out of it, you're probably going to have cash flow. And for one person, it might be a 10% effective rate. For another person, it could be a 30% effective rate. What we do, Eva, we look at your tax return, we look at your mix, we make sure you have the right structure, and within an hour, we can give you a tax consult, a legal consent, and to really drill down on what your tax withholdings should be for yourself, and if you even need to do it. Your CPA should already be doing this for you. If you're not getting that help, any of you on here, pay us for an hour. You're going to freaking love it, and do it once or twice a year. It's like you're willing to go to the dentist or the doctor. That's what a good tax lawyer does, is they help dial you in. If we don't save you 10 or 20 times what you're paying us, then we messed up. Do not think you can just click a few websites and figure it out. Watch Law and Order. Okay, Lenny. I like it. She's so popular, she has the same name 3 times. She said, we inherited a 4-unit building, put about $8,000 worth of work into it, and sold it for the appraised fair market value to our daughter. We had it for 1 month. Well, thanks for giving your daughter a deal. I like it, Lynn. Stick it to her. All right, that's good. We had it for 1 month. It generated a small income during that 1 month. What are the tax implications of this transaction? It's going to be short-term capital gain. You're going to pay taxes on the difference. So you bought it, you put 10 grand into it, and then you sold it. So whatever that basis is you bought it in improvements. Between that and the fair market value, that's your gain. It's a short-term capital gain. If you don't do this all the time, you're not going to have self-employment income. You don't need an S corp. It's just going to go on a Schedule D. You're not going to get capital gain rates. You're just going to pay tax at whatever your rate is. And if you collected some rent in the process, it'll go on a Schedule E. You'll pay some tax on that. Reed comes back, double dipping. Okay, Reed. You only get 2 questions. Make it. Hopefully, it's a good one. I have been constantly borrowing my brother-in-law's truck. Good move. I like that.
That's what they're there for.
Yeah, that's what brother-in-laws are for. When purchasing, disposing big ticket items for my rental properties. That's good. Never clean it. Leave garbage in there. He loves that. I would love to buy a basic work truck of my own. Wouldn't we all? I'd get the Ford F-150, the King Cab. Nice. It's extra. Those are really a good move. Would the truck or part of this purchase be considered a rental expense? Okay, you lost me, Reed. Would the truck or part of its purchase price be considered an auto expense? Yes. I think you had a typo. It wouldn't be a rental expense. I mean, I think you mean an expense for your rentals.
Yeah.
So, yeah, Reed, it'd be a freaking write-off, and your accountant should meet with you, look at your overall tax plan, and look at your other income. We could 179 part of it, which means write off part of the truck in one big swath. Maybe we're going to take mileage. I've got videos on whether to rent, lease, or buy. Reed, this is a big topic. And again, I'm glad you're asking this, but it's got to be tailored to you. So schedule a half an hour with me or one of our tax lawyers. We can dial you in. Now, we have a whole entire separate accounting team. They're in the middle of tax season. They're prepping taxes. You can talk to my accountants after April 15th. But right now, you cannot touch them. They're way too busy. But my tax lawyers are available for strategy sessions. Then we hand it off to the accountant when we're done. PJ says, can landlords deduct large portions of the renovation when purchasing a property instead of depreciating? Okay, PJ, tell us your address and I'll send the IRS over right now. No, you cannot. What are you, crazy? Of course not, PJ. Renovations and rehabs are added to the basis and depreciated. Now, I was just meeting with one of my accountants today. In fact, we had a couple of emails going back and forth on our team. We have about 40 accountants. We're busy. We're helping clients all over the country, people. We're legit. And when you get a property settlement statement, a HUD statement, we divide it and we look at your improvements or purchase price, and throughout the year, what can be classified as repairs, we can write off immediately. What is classified as an improvement goes towards basis. So I'm teasing PJ here, but he's on to something. And that is, you do want to find what I can expense immediately and what I have to add to basis. And certain things are going to go one way or the other. So if I put paint the house, that could be a repair. If I put on a new roof, that would be an improvement. And so we have lists in our office as accountants that tell you which way they go. And again, this is what an accountant does for you. If some of you are trying to hack this out on TurboTax, wake up and smell the coffee. TurboTax is for people with a W-2, 2 kids, and they go to church. That's it. If you're a business owner, stop the insanity, get a real account that knows what the hell they're doing, and quit trying to jack this up on TurboTax. Sorry, I'm not saying PJ's doing that.
Well, I feel like you got to mention too, PJ did say that he really enjoys your podcast, the Refresh Your Wealth podcast. So another plug for that.
Thanks, PJ. And I'm not trying to be rude to PJ. He's probably got a great accountant. Your accountant should give you a schedule and break this down. All right. Now, Chip is now on his second question. I see a third. We may only do one more for Chip, and then we're going to pass around the love. Chip says, I closed on a property in July 2017 and had it rented in December 2017. I know, way too long of a rehab. That's cool. We've all been there. And I'm thinking about selling it in 2018. I've heard I get a better tax advantage if I own it a year. That's correct. You get long-term capital gain, a lower tax rate. But does the clock start upon closing or upon listing or upon renting? That's a great question. Because you turned it into a rental, I will start the clock as of the purchase date. Now, if you're in a rehab for a year, then you turn it into a rental for just a month or two, some accountants are going to go, nah, I'm going to start the clock when you turn it into a rental, and then you can have long-term capital gain. I will say that accountants, this is a gray area where some accountants that are a little more aggressive, the longer you have it as a rental, the better. Some aggressive ones may, come off that a little on the dates. So Chip, you can roll the dice on that. I think technically a lot of IRS agents would say it starts when you put it into service as a rental. But I've had other experiences in cases where it was allowed when you purchased. So you're just going to have to figure that out with your accountant and decide on a risk tolerance. Amos says, I have attempted my mom's, oh, look at this.
I knew you were going to love this one.
Yeah, Amos, you're killing me. I've attempted my mom's taxes last year, adding her rentals. I'm her property manager. Once I was done entering rent expenses, the refund didn't move up or down. I wonder why, Amos, because you don't know what the hell you're doing. Quit playing accountant. And I'm not trying to be terribly rude here. I'm trying to make it a point, people. I'm an accountant. Let me be an accountant. Guess what? I'm not a rehabber. I hire contractors to do that. I hire property managers with a good property manager. I hire people like Rent Prep to find good tenants for me because I'm terrible at it. Don't play accountant. Anyway, the refund didn't go up or down. Was it something I did wrong? Yes. You probably checked the wrong box between active, passive, or real estate professional. And frankly, people screw this up all the time. And if you check the wrong box and you get her a refund, she might get audited too. You're not allowed to make the refund go up unless she's allowed to take it. That's probably why it didn't go up. But again, you might be checking the wrong box. Or is it based on standard versus itemized? No, that has nothing to do with it. Like there wasn't enough to itemize, so it went with the standard deduction? No. Rental property has nothing to do with itemizing or standarding. Amos, do what you're good at. Pay for a good accountant. Love you. Okay, next page. I'm going to jump to people that have not asked questions yet. We're going to go over to Doug. This is Doug Gosling. He says, I understand that I must claim depreciation each year. That's right. Even if the income is less than the expenses, plus depreciation, resulting in a net loss. I know, which we love, Doug. And that this net loss cannot be carried to later years. Wrong. You carry it forward for the rest of your life until you sell any of your rentals or otherwise recovered with respect to taxes. Is there any way to delay claiming depreciation? No. Claim it, Doug. You're onto it, Doug. You're doing the right thing. Claim the depreciation. Carry that loss forward. If you or your spouse qualifies as a real estate professional, it's not even going to be a carry forward. You're going to get 100% write-off. And if you do carry it forward, it carries forward till the day you die. No limitations, and you can write it off against any rental you sell. So if you did not take depreciation in prior years, you need to go back and add that back in there. And anyway, you're loving it. Go into the net loss, Doug. You want it. Okay, Milt says, I think this is Milt's first question. I am planning to retire and sell some of my rentals this year. What do I need to know about filing a final return to figure the tax and to find the capital gains on the property on the final sales price? What items besides repairs can I deduct from the net capital gains amount? Well, Milt, this is another one where okay, I'm going to make a first comment. Milt says, I'm planning to retire and sell some of my rentals. Okay, right there, Milt, I might argue with you a little. I might say, Milt, use your rentals to retire. That passive income is what many of my clients are retiring on. Now, if you need to sell one of your rentals to pay off some credit cards, get into a new living situation, reduce your overall living costs, and you need to sell a rental and capture a little profit to pay some bills, I get it. But don't just across the board sell all your rentals because you're retiring. Heck, I'm buying rentals so that I can retire on my rentals. That's what Eric's doing. That's what a lot of us are doing. So I would say, Milt, maybe reevaluate that point. But when you go to sell, you're going to look at how much you purchased them for, how much you depreciated them for, how much you improved them over the years. If you already wrote off repairs in the past, you don't get to write them off again. Your accountant is going to be a huge resource to you in this process, making sure that you get the maximum basis, which reduces your capital gain. So that's what you want to do. He says, I have saved every receipt for every repair for the last 40 years. Well, if you never wrote off those repairs, then Milt, we're going to add them to basis. But if your accountant was doing what they were supposed to do, they would have written off repairs before and not written off improvements, kind of like my comment a bit ago to Chip or someone, is repairs and improvements are two different things. Milt, I'm hoping you didn't do your own taxes. And he's saying, do I need to add back any depreciation that I took in past years as well? You're going to have depreciation recapture. Milt, bottom line, if you're going through a process of selling a lot of rentals, you've got to get a professional involved to help you on this one tax return. And then if you want to keep, hacking it out on TurboTax next year, go for it. But don't try to do this on your own this year. It's going to be too complicated. Michael says, I hire the neighborhood kid. Oh, this is going to be good. I like where Michael's going with this. Michael says, I hire the neighborhood kid and occasionally day laborers to help with lawn care and leaves. The most I pay any one single person has not exceeded $200 for the year. I keep a log and names and dates and description of work. I know I do not have to 1099 them because I pay them less than $600 a year. Okay, I'm cool with that. I'd get I-9s and a W-9 anyway, but whatever. But will the log be sufficient for record keeping and audit purposes? Yeah, I'm good with that. Good record keeping, Michael. I'm cool with that. Or should I create receipts and have them sign copies? Nah, you're fine. It seems a bit crazy to have a contract or loads of paperwork to pay a 14-year-old kid to mow the lawn. Agree. Oh, and in case you were wondering, I believe he meets the criteria of an independent contractor. He has his own lawnmower, his dad's, and does it unsupervised while I'm not there. That's good. Now, let me say this. Michael's got a couple points that are good and maybe a couple warnings I want to give to everybody. First, Michael, your bookkeeping's great. Keep a good record. If you're paying cash to some contractors and it's under $600, you just keep good records. I'm going to take it as a write-off as your accountant. If any of you pay someone more than $600 or expect to, before you give them a check, you have them fill out an I-9 and a W-9. It's only 2 pieces of paper. You can download them off Google, write on a PDF, print them out. They need to sign them because they'll disappear on you. And when it's time to send them a 1099, you don't have any of their info. So before they get their check, they get the I-9 and W-9. So that would be the only paperwork that I'd worry about, Michael, is making sure that if you think you might exceed $600, make them fill it out. Now, if they check the box they're exempt from a 1099, fine. But you got to have the paperwork to prove it. So do it. Now, I know many of you out there. Now, this is the warning I have for all of you. And this could probably be the biggest point of today's webinar. When you start paying people under the table cash, and you're not writing them a check, and it's under $600, maybe it's $2 or $3 grand and you just pay them cash. Guys, you're taking your livelihood into your own hands. Let me give one quick example. This is so important, everybody. Listen up. I had a client out in Illinois, short story, out in Illinois, rehabbing a property. Bought it for 400 grand, putting about 100 into it. Was going to have 500,000 into this, had some hard money. Is going to sell it for about 700. He was going to make 200 grand on this deal. It was a sweet one. You found a good deal. Well, he's out there doing a lot of the work. He's hiring some licensed contractors for certain things. And then it came to rain gutters. Hires these 2 college kids. They said, yeah, I'll come over here and I'll do your rain gutters. He's like, okay. He paid them both a couple grand in cash, and they get to work, paid him a little bit up front, and then he was going to pay the rest when they were done. He bought the materials, and the guys show up. Well, while they were working on this house, the tree trimmer came by, was working on the trees, told the guys to move. They didn't move, whatever. Some bozo cuts down a branch. Branch falls on one of the guys while he's up doing the rain gutters, hits him in the arm, literally almost severs his arm off. Not good. Client calls me freaking out. He was rushing over to the site. This kid that's working on the rain gutters, and Michael had his own ladder. I get it. He was paying him cash. He was a subcontractor, right? You think? Anyway, helps the kid get to the emergency room, says, I'll pay for all the bills. Let me help you out. He's trying to be Mr. Nice Guy. Kid's very appreciative. It's ugly. It's scary. About a week later, the kid didn't return his phone calls. About a week after that, the lawyer called him. Got a lawsuit for over 50 grand for having someone on his property, unlicensed, not a licensed, bona fide contractor to provide that service, no written contract. He was a day laborer paid under the table. My client was liable. No workers' comp. On the hook. Watch out if that kid mowing your lawn, Michael, sticks his hand under the lawnmower and cuts it off. You want to go over there and tell the dad, I'm not liable because you used your lawnmower? How's that going to fly? Be careful, people. When you hire unlicensed contractors and pay them cash under the table, you very well could be liable. My client ended up paying a bill. He ended up having to rely on some of the insurance on the property, and he ended up having to come out of pocket on some of his profit. Luckily, the lawyer that came after him didn't file a Liz pendants and tie the property up in court because he had hard money sitting on that property. It would have been a disaster. So people, be careful paying people cash and thinking you're okay because they're a contractor using their own equipment. Okay. I'm all yours. Do you have a couple more questions you want to hit? We're into this 45 minutes now. We've got to wrap it up maybe.
Yeah. We've got a few questions from Doc here. I think number three is a nice question to answer.
You throw it up.
Yeah, let's see here.
Oh, yeah, of course it's nice. It's a freaking book. Jeez, Doc. All right. Will the interview be recorded?
Yes.
Okay.
We're going to send it out to the newsletter. It'll be recorded, and we'll also have it up under the landlord resources where we have other resources from you, Mark. We're going to add it to that page.
Cool. Thanks, Eric. Okay, my husband and I own 2 multi-unit properties in Pennsylvania, which are not fully rented because we are still working on them. We file a joint tax return. We are within 10 years of retiring, hoping to use the rental income as pension-based tax, but tax laws make this less lucrative than I thought. No! Hey, Doc, tax laws are awesome for rentals. They have not changed. They're freaking amazing. Owning rental property, tax-deferred, tax-free cash flow is amazing. Doc, do not assume that tax laws are working against you. The National Association of Realtors and all the different associations lobbying for real estate investors, freaking amazing. Do not think that rentals is working against you from a tax perspective. It's working for you. Let me keep reading. Number 1, mileage expense. I was surprised to see in a blog post that mileage from my home to my rental, can you throw it up again? I can't see.
Oh, okay.
Mileage from my rental is not deductible. Who in the hell said that? I would never say that. Who's this blog post? You know what, guys? This is a great example of Doc again. No offense. Doc reading a blog somewhere, assuming that this blog was accurate. Is this blog writer a CPA? Is the CPA going to sign Doc's tax return? Is Doc going to take this blog as gospel and then go do her tax return on TurboTax? This is what I'm talking about. See, Doc could go find 3 other articles that give her the answer that she wants, and then she goes and does it. Just because someone blogged on this, you got to look at their credentials and are they signing your return? Hell no. Mileage from your home to your rental property is certainly a write-off. If I travel from my work address to my rental, is that deductible? Yes. How about if I travel from one rental to another? Yes. Okay, number 2, I'm a bit confused by the QJV box. I am assuming I am better off not checking the box. Can you confirm this for me? Do you know what a QJV box is?
Yes, I actually just looked that up earlier. What is a QV? A qualified joint venture.
Yeah. What box on what form?
Yeah. You know what? For this one, I was thinking just number 3 that I was curious about, Mark. It was I was going to word my lease so tenants pay $500 rent and $400 for heat, hot water, etc. I just saw something that says the whole $900 must be claimed as income on Schedule E, even if it's labeled labeled this way. Is that right?
Yes. So if you, and we'll come back to the QJV thing, Doc. Okay. So if you tell a tenant they're paying $500 of rent and $400 in water and heat, and they give you $900, you have to claim all $900 as income. But you're going to write off $400 for the electric that you're paying, apparently, right? You're charging the client $400 for utilities that they're paying you, and then you're going to turn around and pay it for them. So you're net back at $500. So you have to claim everything the tenant gives you, but then you get a write-off for anything you're paying for the tenant. So if you do an all-inclusive lease where they pay you one fee and then you pay all the utilities for them, well, you get a write-off for all the utilities. So you're back where you started. So it's okay, but you don't want to be in trouble with the IRS. Claim the entire $900, then write off the freaking utilities, and you're back where you started. It's a good thing.
All right.
Now, on the QJV thing, let me just say this. A qualified joint venture, again, some blog writer probably came up with this or some form. Something. Hey, here's the thing, folks. A qualified joint venture is code for general partnership, which is code for if there's a lawsuit, I just got sucked into it, which is code for I'm going to lose my own personal residence or have a judgment against me, which is code for you don't do qualified joint ventures, you do a freaking LLC and do it right. So people, be careful there. I know I'm kind of excited and animated. I'm not trying to be rude to anyone, especially Doc here, but get a lawyer involved and do it right. Be careful of a joint venture.
Yeah. All right. Well, some of the resources we've done with you before, too, I'm going to be including those in this thread here. I'm going to be linking out to Mark's website where you can get in contact with him, get on his newsletter. And then we also have a bunch of information about LLCs from a previous conversation, too, that people can check out. And I'll reach out to your people, Mark, too. If there's any specific resources they want to share, we'll make sure that makes it into the thread as well.
Thank you, Eric. And this Mountain Dew is for you. It's a good year.
Yeah. Yeah. Thanks so much, Mark. We appreciate it.
All right. See you, man.